Hello everybody, welcome to Rachel's classroom. In this video, we will be discussing discounted payback period method. In this method, we will be taking into consideration the time value of money and the firm's required rate of return. By doing this, we will be able to overcome one of the limitations in the undiscounted payback period method. So, when payback period is calculated by taking into account the discount or the interest factor, it is known as discounted payback period. Now, let's proceed into the video. Here we have a problem where they are asking us to find both traditional payback period as well as discounted payback period. They have given details such as initial outlay, that is the initial investment, which is 80,000. The estimated life of the project or the machine is 5 years. And for 5 years, profits after tax is also given. They've also mentioned that the depreciation can be calculated using straight line method. And they've also given the cost of capital is 20%, where they have given the PV factor values. Let's see how to work this problem out. So in the traditional method, the first column is taken as year. The second column is profit after tax, which is given in the question. Depreciation we have to calculate, that is initial investment, that is 80,000 divided by the life of the project 5 years. So it is 16,000. Depreciation, since they have specifically told straight line method, we have taken 16,000 for all the 5 years. Here the cash flow, see, since depreciation does not actually flow out of the business, it's still within the business, it is also included in the cash flow after tax. So basically CFAT, cash flow after tax, is profit after tax plus depreciation. So 6,000 plus 16,000 is 22,000. 14,000 plus 16,000 is 30,000. 24,000 plus 16,000, 40,000. 16,000 plus 16,000, 32,000. 0 plus 16,000 is 16,000. And we find the cumulative values. Like I mentioned in the previous video, our initial investment is 80,000. We have to find in which year do we get the closest value to 80,000, the lower range. So 52,000 is the closest to 80,000. So we are making 52,000 in 2 years. The rest of the money, that is 28,000, we are making it in the third year. So third year the cash flow after tax is 40,000. So of that 40,000, we have to make 28,000. So 12 divided by 40,000 into 28,000, approximately 8 months. So according to the traditional method, the payback period is 2 years and 8 months. We are going to see how discount factor will affect the payback period in the discounted payback period method. So here we are going to take the cash flow after tax and multiply it with the PV factor at 20%. So when you multiply, you will get the discounted cash flow after tax, 22,000 into 0.83. You do as usual, you calculate the cumulative values and you find the closest value to 80,000. In this case, 77,520 is the closest to 80,000. So we are making this amount in the fourth year. So the rest of the amount is made in the fifth year. In the fifth year, the actual cash flow is 6,400. Of this 6,400, we are going to make the rest of 2,480. So 12,000 divided by 6,400 into 2,480, which is approximately 5 months. So according to the discounted payback period method, the payback period for this project is 4 years and 5 months. Thank you.